Morning, everyone. My name is Dustin Beekman. I'm the AVP of Business Development at the Medical Society of Virginia. I'm very excited to be here with you all for today's webinar in partnership with our good friend Matt Brotherton at 1752 Financial. Matt is here this morning to provide a brief presentation on retirement planning. So a little background on Matt. He's the president of 1752 Financial. He started in the financial services industry after graduating from Roanoke College in 2000. Matt and 1752 have been a long-standing MSV partner, and they offer services relevant to today's physicians. Before I turn it over to Matt, I want to go over just a few housekeeping items. If you'd like to ask a question, please utilize the chat function at the bottom of your Zoom screen. If you have any questions that aren't answered on today's call, please email us, the MSV team, at memberservice@msv.org, or I'm sure Matt will have his email address, contact information as well. So on behalf of the Medical Society of Virginia Insurance Agency, I'd like to thank everyone for taking time out of your busy schedule with us this morning and being with us. Now I will hand it over to Matt.
Cool. Thanks, Dustin. I appreciate that intro, and obviously I've enjoyed working with MSV and obviously all the members for the last 10 or so years. Today, the plan, like Dustin had mentioned, is to discuss a topic that is top of mind for a lot of folks, which is retirement. Retirement means a lot of things to a lot of different people, whether that's retiring early, whether it's working long and having a long retirement. And obviously in this day and age, it's always thinking about how much money that we will need to have and how much money that we've saved so far and the different options that are available to you. So this is a time for you. So if there are questions that do pop up, feel free to enter them in the chat, and we'll address them as time permits. So going into today, there we go. So we always talk about retirement as a general, and the idea of how confident that you are saving enough for retirement. And we think about all the different risks that are involved in retirement. And also, does the plan that you have protect not just you, but also your family and those that are dependent on you to earn your income that you have? And we think about the stats that are out there, and very few people, 18% of those, are confident that they're saving enough for retirement. And I think if we think about the last 10 or so years, prior to last year, the market was doing great. Everything was booming. We were earning 5, 10, 15% a year, depending on how risky you were. A year like last year kind of puts everything into perspective. We think about the potential of last year where you might have lost 15 or even 20% of your nest egg. And that's a big hurdle to overcome potentially if you're getting closer to retirement. So when we think about that, we also have to think about then what other options are available to you that you may not have thought about. All right, there we go. So these are the different risks that people think about when it comes to retirement. The big one is the things that I talk about a lot with clients are the inflation risk, which obviously has been top of mind in the media almost every day. It seems like with the Fed interest rate rising, inflation being a big number over time. We also think about longevity. How long are you going to live in retirement? And obviously we don't know that fact. But with doctors, you all doing what you're doing medically and people living a lot longer, we have to think about potentially 30 or even 40 years in retirement. 20 years ago, that number was 10 or 15, 20 years. So as people live longer, we have to make sure that our assets are going to be enough so that we can potentially live 40 years in retirement. Taxes. I just looked this morning at the national debt, and we're at $31 trillion of debt. Where that money is going to come from, I'm sure the government will come up with some solutions, and most of those solutions will come back to taxes. Right now, relatively speaking, taxes are relatively low. So if time goes by and taxes go up to 40, 50, 60%, we have to think about other solutions that we can pull from when it comes to retirement income needs. Obviously, a health condition. We don't know where that's going to fall. We can look at family history to see what has happened to others in your family But of course, we don't know what's going to change with you, whether it's a heart condition, cancer, something else that might pop up. The withdrawal rate. Typically, when we think about retirement, the rule of thumb is to pull 4 or 5% of your savings in retirement on an annual basis. So if you have $1 million, that equates to about 40 to 50,000 a year of income. And we think, is that enough based on your current income base and your current expenses? May or may not be. Now, I do think Social Security is something that a lot of clients ask about. And in my opinion, and a lot of other people's opinions, Social Security will be there. Is it going to be in the current state that it's in now long term? Maybe, maybe not. The thought is that they'll make it later. So if you are, let's say you're 30 years old currently, you may have to wait till you're 70 before you can take full Social Security. But I don't think Social Security is going away. All of us are paying into it now and will continue paying into it. So of course, over time, that should be there as well. The big thing that factors into retirement, of course, is called sequence of returns. And what that means is when you retire, what does the market do over the next 5 years or 10 years? The big thing that, let's say you retired last January, and we didn't know, of course, the market was going to drop by, let's say, 15%. If you start with that easy numbers, let's use $1 million, and the market drops by 15%, and you're taking 5% out, your $1 million just dropped by 20%. So at the end of last year, your $1 million just turned into 800,000. And now if we're taking another 5% out, now your assets are dropping that much quicker. So sequence of return risk is a big thing when it comes to retirement. Now, one thing that I suggest a lot of clients do when it comes to retirement is a bucket strategy. So having 3 different buckets of where your money is positioned so that you can be more secure when it comes to retirement. One idea is to have 1 year or 2 years of expenses set aside in a very safe, almost like a money market type account, so that if the market does dip, you know that you have 2 years of expenses set aside in a very safe bucket that you can pull from for income purposes. The second bucket would be a little bit more aggressive, but it is earning interest over time. And then you have your longer term bucket that is there to earn interest, which then feeds the first bucket as your income need goes away. So there's different strategies that people use. That's just one that I recommend for clients. When we think about retirement and we think about what you're saving now, most physicians, most practices, most hospitals offer either a 401k, a 403b, or a 457 plan, or some combination of those plans. Some practices also offer what's called a defined benefit plan, which is just another qualified retirement savings plan that's set up by the government, or legalized by the government, of course. So I help folks look at the total picture to decide where the right spot is and which vehicles to utilize when it comes to retirement savings. A rule of thumb is to try to save at least 15% of your income. So to real numbers, if your income is $300,000 a year, that's $45,000 a year that you should be saving in some type of retirement vehicle. If it's $500,000 a year, now we're looking at $75,000 a year of income that you should be saving in some type of retirement vehicle. The reason 15% is used is just all the studies that are out there. If you're able to save 15% a year of your income, long term, you should have enough money to retire at a comfortable age of 65. Now, these are some of the other options that are available as well that a lot of people don't think about. Life insurance is one that a lot of folks utilize after you've saved enough, or after you've maxed out the vehicles that are offered by your employer or self-employed vehicles that are offered to you. So if you're, let's say, 45 years old and you are saving into your 401k, the most you can save out of your own pocket is $22,500. This year, if you're 50 years old or older, the max you can save is $30,000. So above and beyond that, at those income levels, you're not eligible for a Roth IRA. you are eligible for using life insurance. Life insurance has a lot of the same characteristics as a Roth IRA, where the money that you're setting aside is after tax, the money grows tax deferred, and you're able to take the money out of a life insurance vehicle tax-free as well. So it looks and smells like like a Roth IRA, but it's a vehicle that there's no income limitations. A Roth IRA has income limitations where if you're a husband, wife, domestic partner situation, if your income is over $228,000 of adjusted gross income, the government does not allow you to participate in a Roth IRA. So a lot of clients are utilizing life insurance as another savings tool when it comes to retirement after you max out your qualified plans that are offered through your employer, especially if you have a life insurance need. If you don't have a life insurance need, it may not be the right fit for you. But if you have a need for life insurance, if you are looking for additional savings, and you want to protect yourself from long-term care situations, then that's a nice combination of options that make life insurance an important vehicle to think about when it comes to overall retirement savings. So not obviously taxes are top of mind. You know, a lot of people want to discuss retirement and how taxes will play into it. Like I mentioned, assets that are held in retirement plans, so that's your 401k, any type of pension, any traditional IRA, currently are going to be taxed at your income tax rate. So if you have that $1 million again number and you're taking out $50,000 a year, the $50,000 that you are taking out is going to be taxed at ordinary tax rates, which may be less than what you're getting taxed at today, but of course we don't know what tax rates will be come retirement. Assets that you hold outside of retirement plans, like individual stocks, individual mutual funds, real estate properties, rental properties, etc. Currently, those are taxed at capital gains rates, which depending on how much you take out, can be somewhere between 0 to 20%. Traditionally, it's less than income tax rates, but obviously all this is subject to change depending on what the government decides to do when you do retire. So if you are, going back to the ages, if you're 40 years old now and you're going to retire, your plan is to retire at 65, 25 years from now, that's potentially 6 presidents from now. So we don't know what rates are going to be. We don't know what taxes will do. We don't know what capital gains taxes will be. But it's important in my mind to diversify where you're invested so that you know what your options are when it comes to retirement. And then some of the often overlooked assets are a Roth IRA, life insurance, and those today are, when you take distributions, are tax-free. Now, a lot of 401k or 403b plans do allow for Roth contributions, but once again, you're limited to that current numbers, $22,500 or $30,000 if you're over the age of 50. So that's where the idea of utilizing life insurance as another vehicle for savings benefits is something to consider. And with a lot of my physician clients or business owners, CPAs, attorneys, I have folks that are setting aside somewhere between $500 a month to $5,000 a month in the life insurance vehicle on top of what they're saving at their employer setting as well. So once again, if we're trying to save 15% a year and you're a higher earner, we have to look at different vehicles to utilize to save that additional money. And certainly you could just use an after-tax investment vehicle and let the money sit there and accumulate over time. But like the chart shows, you're going to have to deal with some capital gains tax when you do take those distributions. So once again, a lot of CPAs, a lot of tax attorneys will agree utilizing life insurance is a surprisingly tax efficient vehicle. The life insurance, of course, if you were to die prematurely, die while you're still in the working years, the death benefit is generally tax-free to the heirs. There's also options where you can set up a trust to own the policy, so it's outside of your estate, to reduce the potential estate tax rules that are out there as well. Growth of the life insurance, the cash value that's inside the life insurance policy is also growing tax deferred. So you're not going to get a 1099 at the end of the year like you would on an after-tax investment account. And then the life insurance withdrawals that you take are also currently tax-free as well. So it's a Roth on steroids is what a lot of folks refer that to, where the money is after tax, it's growing tax-free. And then when you take out distributions, the distributions are tax-free as well. And then if you lucky enough to live to your 80 or 90 or even 100, whatever is left from a death benefit standpoint is left to your heirs, charities, etc., in a tax-free manner as well. So it gives you that ability to have tax-free income while you're living, and then a tax-free distribution at your demise as well. So, once again, when we're thinking about retirement, I always like the bucket strategy. So I would encourage you to think about different ways that you're saving the money. So obviously the retirement accounts at work, maximizing the vehicles that are offered, the 403B, the 457, the 401k, are all great things to do because of that tax savings. And if you use the Roth limit of the 22,500 or 30,000 if you're over 50, that's another nice option that you have, because there's no income limitations when you're thinking about a Roth vehicle through work. After that is maxed out, which a lot of physicians max out early in the year, you're looking for additional places to save money. And that could be that after-tax investment account, or using the life insurance, because that's just another forced savings. It's part of your budget. You know that X amount is going into the account every month, whether that's that 500 a month up to the 5,000 a month that I see clients do. So it's just part of your accumulation phase. Once we get to the discretionary income phase, we need to think about how much income that you're going to need come retirement. So working with somebody like myself or a current advisor, it's looking at how much income that you need to pay your expenses so that you can maintain the lifestyle that you live. And then it gets to that distribution phase later in life, as far as what do you want to do with your assets? What kind of legacy do you want to leave? Do you want to leave it to a charity? Do you want to leave it to kids or grandkids or the MSV even? What are your options that you want to leave? What kind of legacy do you want to leave for those that are left behind? So all that is part of working with somebody like myself to look at where you are now, where we're trying to go, and ultimately what's the end game that we're trying to accomplish in this life. And I know you're busy. I know there's a lot of things that you have to deal with, and all the patients and all the paperwork and everything else in between. But by having the right person on your team, this is all accomplished. A lot of it's behind the scenes, putting a plan together for you to make sure that all your goals are met and that you're ultimately happy with how things are going. Ultimately, I do feel that one thing that's missed a lot of times is the review. Making sure that your advisor is getting in touch with you on a regular basis, making sure that you understand where your money's invested and how it's invested and what the ultimate plan is. That's something that we do for clients, where we keep in touch once a month. You'll hear from me once a month with information on what's going on. You'll hear from us to set up reviews. So there's a lot of information that I provide to make sure you understand where things are, how they're set up, and make sure that you're set up for retirement in the right manner. So not to keep talking about the life insurance option, but when it comes to life insurance, there's a couple different major types. And obviously, if you decide that you want to spend some time to talk about these options, everything is customized based on you and your situation. So to touch on life insurance as a whole, there's term insurance, which a lot of people have heard of. Term insurance is there for a period of time. It's a 10-year, 20-year, 30-year term typically. After that window of time, the term insurance goes away. So it's a lower cost way to insure yourself, kind of like renting. After the lease is up, you move out, and that's you had the place where you're there, but there's no benefit, there's no cash value. It's simply there to insure you during that window of time. Then there's permanent life insurance, which is what I've been speaking about mostly today. And that's the type that is after-tax investment. The money grows tax-free. And then when you take distributions, the money comes out tax-free as well. So the other thing that we can add to long-term or to life insurance is a long-term care feature as well. So long-term care is nursing home protection, assisted living protection, and also your home health care protection as well. So God forbid you need to go to a nursing home, whether it's in your 40s, whether it's 50s, or in your 80s or 90s, there is a benefit that you can utilize through a life insurance vehicle. So this is another feature that we can add to the policy to ensure you're protected so that you don't have to liquidate assets when it comes to the nursing home cost that's out there. Within a life insurance plan, there's 80 different mutual funds that we can choose from. So we can be as aggressive or conservative as you want to be. And that can mirror your 401k or 403b accounts as well. So all those are advantages that are just part of a policy that are incorporated to ensure that you're protected and you're diversified as far as how the money's invested for you as well. So some of the next steps, and this is totally up to you. I'm here as a resource for you. Like I said, and Dustin had mentioned, I've been partnered with MSV for quite some time. I work with hundreds of physicians across the state. I'm here as a resource. I'm not tied to any one particular company. The way I look at it is I work for you. My job is to get you the best plan based on your situation and what's the need that you have. So I would help put together a plan for you based on how risky you want to be, talk about your retirement accounts at work, put a plan together that wraps everything together to ensure that you're saving enough for retirement, that you are protected in the short term and also in the long term, and of course give you options to consider when it comes to savings and what your options are out there. My information's on the screen. My office number and my cell phone and my email address are all there. I've enjoyed working with MSV and Dustin and his team, and obviously the members throughout the years. If you have somebody that you work with already, that's great. I would encourage you to ask them some questions to ensure that you're on track. Have a plan put together that shows where you are now based on your income and expenses, where you're going to be in the next 5, 10, 20, 30 years. Obviously, those plans are going to change quite a bit, but at least you have a snapshot of where you are and where you're trying to go, and just make sure that you're on track for that retirement goal. And if we start young enough, then there isn't even the opportunity to retire early, which is something that more and more people are trying to do these days, and be financially independent so that you have the choice whether you want to continue working or if you're able to stop working. So that's the information I had here to share today. Obviously, I appreciate your time. I appreciate you listening. If there are any questions that you want to enter, feel free to enter those in. If not, I understand, and I'll be in touch to help answer any further questions. But if there's anything else, any questions, Dustin, you have that you want me to touch on, I'm happy to do that as well.
No immediate questions. I think, this is a great overview. And I agree. I mean, sometimes I think it's good just to maybe take a pause, right? And let's take a snapshot of where we're at. I mean, I could even say that with me personally too, right? So, I think it was very informative and it was good, and it kind of helps reframe and, maybe say, hey, look, it might be a good idea for us to take a look at where we're at. And sometimes we also get comfortable if we've been working with someone for a long, long time. And so maybe it's just a good opportunity to go back to whoever you're working with and maybe even get a second opinion. I mean, if we're going to put it in medical terms, sometimes a second opinion is not a bad thing. So, especially when it comes to planning, don't necessarily make the assumption that they've got everything right all the time. So, no immediate question. I think it was great information.
Great.
So I appreciate you, Matt.
Sure.
And maybe just close it out to say, thank you for everyone on the call again, for taking time out of your busy schedules to participate. If there's anything that you can think of question-wise afterwards, feel free to reach out to Matt directly or us. we're happy to help. Part of our mission at MSV is to provide as much education and communication to certain things that can help not only you all personally, but professionally. And so hopefully this was of value to everyone this morning. So Matt, thank you again. Really appreciate it. Really appreciate your partnership. And with that, I guess we'll bid adieu, right?
Yeah, sounds good. Thanks for your time again. And I'm here to help and here to be a resource for you. Thanks again.
Yeah.